and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, October 27th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we are showing futures that are mixed. We've got Dow futures up significantly, up over 200 points, up 228 points to be exact. S&P 500 futures basically flat, and NASDAQ futures down 55. So definitely a bifurcated market in pre-market. We'll see how that translates when the market opens, but at least for now, it looks like we're going to open up mixed. Crude oil prices up just slightly, up 31 cents a barrel, back above $88 a barrel. And the 10-year Treasury yield, which had been declining, back down near the 20-day moving average, is back up 5 basis points today to 407. So that is going to be a key because that's been one of the drivers, I think, to the market. Recently, we've seen the NASDAQ underperform. I think a lot of that has to do with the rising rates. So we want to keep an eye on the bond market, see whether or not the 10-year Treasury yield has peaked. If it goes back to new highs, I think you got to continue to at least monitor price action. All bets could be off to the downside. I think that's the one major wild card at this point is how high rates are going to go. But we'll keep an eye on it and continue to report on that throughout the week. For those of you who are new to Earnings Beats, I'm going to walk you through our website, but I do want to first just share today's agenda with you. We are going to get into the daily market recap. Then we're going to do the regular Talking Technically segment. Then we're going to look at the Dow Jones 30 components with relative strength. I'm going to try and go through those 30 stocks with you very quickly. We are entering a much more bullish period historically. It doesn't guarantee us anything, but from the close at, the close on October 27th to the close on January 18th, if you just look at those two closes, the last 71 years, we have been higher on January 18th, 62 of those 71 years. We weren't higher in 2008, 2009. So for those of you who think, hey, this is a secular bear market, this is different, maybe you'll be correct. But 62 out of 71 years is a pretty strong probability that prices will go higher. We'll see what happens in 2022 into 2023. Then we'll go into earnings spotlight, wrap up with the 3 you must see, and we'll get all of that started here in just a minute. First, I want to walk those of you who are new to Earnings Beats through our website. If you go to earningsbeats.com, scroll down. First thing I want to mention is we have a huge event coming up on Saturday, November 5th. This is Understanding Market Manipulation for More Profitable Trades. I think you have to understand what's going on under the hood in the stock market. You can't just look at what the S&P 500 is doing. You have to understand relative strength. You have to understand rotation. You need to understand there are times of the month where the market is much more vulnerable, where it is much more likely to go up. You need to take a look at what's been happening in 2022. I mean, the manipulation's been pretty extreme this year, much more so than in others. I think obviously the bear market has a lot to do with that, the fear, the panic. But when you look at what's been going on, I think it paints a completely different picture than what you see on the S&P 500. So we'll be going over all of that on Saturday, November 5th. It's going to start at 10 a.m. You do have to be registered to go. It's a free event. So all we take is name and email address. But you can click on that. You can learn some more details about the event. And then also, if you're not interested in the event, you can still sign up for our free Earnings Beats Digest newsletter, which is published 3 times a week, Mondays, Wednesdays, Fridays, normally out by 8:30 in the morning. At least that's the goal. All that takes a name, email address, hit that subscribe button, no credit card required. You can unsubscribe at any time. I like to focus on things that are really important to us at Earnings Beats, which just by our name, earnings are really important. Fundamentals are still at the core of what we look at. So we're going to focus a lot on earnings related gaps, candlesticks, volume, course price volume, trend lines, moving averages, many of the standard technical indicators. PPO is big for me from a momentum standpoint. which is very similar to the MACD, but there are some subtle differences. Mostly PPO is shown in percentage terms, whereas MACD is shown in dollar terms. That's the biggest difference. And it makes comparability of multiple securities possible. You can look at the momentum of, Chipotle, which is a $1,500 stock, and compare that to something like Sirius, which is maybe a $6 stock. I don't even know where the stock's trading right now. But if you look at MACDs, you can't compare the two because they're price-based. So, of course, the numbers are going to be much higher on a much higher dollar stock. But PPOs level the field. Anyhow, sometimes you'll see focuses on that. But I think it's a great newsletter. We try to use this newsletter to give back to the community, try and teach folks who want to learn more about technical analysis or just want to improve their current skills. This is really the newsletter for you. All right, let's move on to the daily market recap. So what happened on Wednesday? Well, the big news on Wednesday was we had Microsoft report. We had Google report. We had Texas Instruments report. Visa reported. And the reaction to those earnings reports were quite different. And that's what you're going to see in terms of the performance on the major indices. The Dow Jones Industrial Average finished up 2 points yesterday, just flat. S&P 500 down 28, which was down 0.75%. The NASDAQ was down 228, down over 2%, slightly more than 2%. And again, a lot of that had to do with the fact that you've got more representation in the NASDAQ by companies like Microsoft and Google and Texas Instruments rather than, in the other major indices. The S&P has those companies as well, but they're smaller percentages. Their market cap is smaller, so on a percentage basis. So that's why you're going to see some of that impact. But some of the key industry groups that help to drive the NASDAQ, talking semiconductors, software, internet stocks, these stocks continue to have tremendous issues. And as a result, we're not seeing the same reaction move to the upside in the NASDAQ that we've been seeing in the Dow and the S&P. The Dow's been really strong, actually. I mean, you can see went up through 32,000 yesterday. Didn't finish there, but we did move up through 32,000 before reversing and falling back to the flat line by the close. But again, look at the AD lines continuing to be relatively strong across all of our major indices. I like that. I think that continues to be positive. If these turn down, that would be a much more meaningful negative to me in the market. And when I talk about turning down, I mean price action. If we go back down to the lows, I would want to see that AD line go back down to the lows, not hovering up here near 2-month lows. I'm talking about going back down to the 2022 lows. Without that, there's obviously buying in the market. That's how the AD line is. You're looking at where you finish in the day relative to where you traded in the day. The only way AD lines stay up or go higher is because there's enough buying to keep those prices at the end of the day in the upper end of ranges, of daily ranges. How do you get in the upper end? You've got to have buying at some point later in the day. You've got to close up in those areas. So anyway, I think the AD line it's not a primary indicator, but I think it's a really strong secondary indicator that we have to continue to monitor. Mid caps rose 5 points yesterday. Small caps also up 4. So they were up fractionally, not bad. Although they too came down well off their earlier highs. Leading the market to the upside were the energy and healthcare sectors. You can see these were the two groups that were actually up more than 1% yesterday. To the downside, and this is the negative, communication services, technology, discretionary. Those are your 3 aggressive groups. In my opinion, the 3 most important aggressive groups. If you're looking for the stock market to resume its secular bull market and really have a rally that's sustainable to the upside, these are 3 groups that need to perform better, certainly better than they did yesterday. 10-year Treasury yield. We've got a few economic reports out later this morning. By the time you're listening to this, you will have seen the economic reports. September durable goods expected to rise 0.6%. August was a drop of 0.2. So we're looking for a pickup there. If we strip out the transports, September durable goods expected to rise just 0.2%, which matches the August level. Q3 GDP initial estimate due out this morning. The estimate is 2.3%. If you're a stock market bull, you'd really like to see that number come in less than that. But remember, the last 2 quarters, we've been negative, which used to be a recession. Now the government kind of does whatever it wants to do. It basically will call the recession. I think what you're going to need to see is unemployment move up before the government is going to call any type of recession. Anyhow, the Q2 final was minus 0.6%. So we are expecting a big turnaround for Q3. Initial jobless claims out later this morning. Last week, 214,000, which was much less than expected. This week, we're looking for 223,000. All of these reports will be out later today. All right, talking technically, moving on. The S&P 500, here was your failure yesterday at the 50-day. Went through the 50-day, failed, came back down. Also, look at this 3,900 level. It was just 2 weeks ago, a little over 2 weeks ago, I said I really thought the S&P could make a run for 3,900. Well, yesterday's high was 38.86. I think that's close enough. Now, here's the big question for me. Do we hold the rising 20-day moving average on a pullback? That is going to be critical. And I think that's going to be somewhat in concert with what happens to the bond market. Where does the 10-year Treasury yield go? Because again, if we go back to this chart, you can see the 10-year Treasury yield pulling back near that 20-day. But if we turn around and bounce here and go right back to another new high, I think that's going to be viewed pretty negatively by the stock market. So I don't know. Right now, as I said earlier, let me give you an update on that. Right now, we're up 6 basis points to 4.076. That's where we currently stand on the 10-year Treasury yield. All right, S&P 500, want to mention just those sustainability ratios with that test of the 50-day moving average. QQQ versus the spider, down. I think a lot of it just recently has to do with earnings. That was a big part of yesterday's drop. But hey, 10-year Treasury yield has gone up 70 or actually 80 basis points from the high in June to where we peaked just recently. So if you had told me back in June that we were going to go up another 80 basis points in the 10-year Treasury yield, 75, whatever it was, I would have thought we probably would have been a lot lower at this point in this ratio. So yes, we are slightly below this May low, but considering how much further we've gone down in the overall market from where we were in May to where we went to, I don't think that's horrible. And my other ratios continue to remain above the lows that we saw from back in May. That's the discretionary versus staples, which has come down during this recent pullback, but still well above. I mean, we got down to 1.90. We're still sitting at 2.03. I think we're fine there. IWF, IWD also been rolling over. But again, this is growth versus value. Interest rates up 75 basis points. And they're still holding on to the relative low that they saw back in May. There's the 10-year Treasury yield I put on this chart, just so you can see the significant increase over the last 2 to 3 months and what that's done to these ratios. But they really haven't broken down other than the QQQ spider, which was barely beneath that May low. And then the final thing I want to show you here is the VIX. The VIX now is back down to 27. It's the lowest close yesterday we've seen since back in mid-September. So fear is coming out of the market. Now that's normal when the market's moving up. But when we went back up here, we barely cleared where we were before, did not even get through 3,900. And yet we've got the VIX back down to 27. Notice every time the S&P has gone to a new low, the VIX has put in a lower high. The VIX should be moving up. You should be getting more fear as the market moves down. We're seeing less fear. That is an important component of what we're looking at. Here's the NASDAQ 100 price action. We did not get up to the 50-day, and basically we just tested the recent high. The interesting part here is that look where the VXN is. This is basically the VIX for the NASDAQ, volatility index for the NASDAQ. Here, you can see the VIX is actually, or the VXN has moved to a lower price, even though price action is basically equal. And yesterday, that was a pretty big drop. We lost 200 points on the NASDAQ, closing on the low. The VIX, the volatility index for the NASDAQ 100, down yesterday 2.5%. That ought to make you sit back and go, big down day on the NASDAQ, and the volatility index for the NASDAQ goes down. So even though we have these earnings reports coming out and these, the guidance not so great, volatility is going down. Fear is coming out of the market. I view that bullishly. That's my interpretation. Feel free to disagree. All right. We want to take a look at the Dow 30 components. I'm going to go through these really rapidly, try to give you my take on what I think is neutral, what I think is bullish, what I think is bearish. Looking at Apple, Apple remains a leader. It's been sideways consolidating. It has not gone down below the June low. I actually give Apple a little bit more of a bullish signal here. Amgen, love Amgen. Look at all the sideways consolidation, just broke out. There are areas of the market that are doing really well right now. Amgen is one of them. It's breaking out relative to its biotech peers, and it's breaking out on an absolute basis. Love Amgen. Any 20-day test upcoming would be a buy point for me on the stock. American Express, been trending down, but doing okay relative to its consumer finance peers. I'm going to give it a neutral. Just hold on to the support recently down near 130. Boeing continues to slide relative to aerospace on an absolute basis. Still, I don't know. I'm going to say that this one remains more bearish. Support down around 120 or so, 118, 120. That would be an area to watch to the downside, but it continues to trend below the 20-week, which is below the 50-week. I think you got to be careful with Boeing. Caterpillar trending down on a relative basis. Its peers have been doing really well, by the way. So the fact that Caterpillar has been underperforming, especially significantly underperforming since the beginning of June, makes me a little bit nervous. Let's get through 200. We're up at a key area right now. Can we get through? Salesforce.com in a downtrend, relative downtrend, clearly remains bearish. Cisco downtrending, relative strength, kind of so-so. I think it remains in a downtrend. We do have positive divergence here on the weekly chart. Potentially, we could get back up into the 48, 49 level, test that 50-week, which is at 49.08. But overall, I'm going to say this still has a little bit more of a slightly bearish tone other than, again, maybe resetting that PPO. CVX, Chevron, trending higher in a great area. Relative strength, not as great. So I think there are other better plays in energy, but I think CVX looks pretty good. Disney, downtrending, but look at the relative strength versus its broadcasting peers, showing a lot of relative strength while the group overall continues to go lower. Disney actually is holding on to that 90 support. I think that's a good sign, but $90 would be my line in the sand. Don't want to lose that. Dow Holdings continuing to drift lower. Here's your relative strength. Downtrending. I think as long as you're below that 20-week moving average, I would be careful. That's bearish to me. Goldman Sachs, I think, is improving. I like the relative strength here. A break above about 355, 360 would be bullish. Home Depot, trending lower. Relative strength, okay. Let's hold on to that double bottom low around 265. Honeywell, trending lower. Absolute price. Relative strength, though, gaining steam relative to its peers. So I think if it could take out this top, you can see the recent bottom around 195, and then the tops up here near 200. If we can get through that level, I think Honeywell would turn bullish in my view. IBM, I like IBM. It went back down in September, put in another bottom. It's rallying again. I'm telling you, the big level in this stock going back 10 years is 145. Watch for that breakout. That would be really good news for IBM. Intel, horrible. One of the worst semiconductor stocks out there. Just continues to fall off the face of the earth. Just not a good company. I would stay away. Johnson & Johnson, sideways consolidating, but relative strength, not so great. I think it's okay. I think it's a safer play. I think there are better healthcare stocks. JP Morgan, trending lower, but starting to show strength. I like this pop with its recent earnings, getting back up in terms of relative strength, moving to a 2022 high in relative strength. Let's watch that 20-week moving average. As long as that holds, I actually like JP Morgan here. Coca-Cola, bouncing back up. PPO is weak, though. I think it's going to fail here at the 60 level and roll over. I like Pepsi better. McDonald's, moving up, sideways consolidating, really strong relative action. I think McDonald's would be in the bullish category for me. 3M continues to trend lower. We had a slight positive divergence with the low back in June, July. Not anymore. We broke back down. Look at the volume pickup. There is no substitute for a price breakdown with heavy volume. I don't care what the MACD or PPO looks like. When you get a heavy volume breakdown, respect it. 3M getting a little bit of an oversold bounce here. Watch that 20-week. I think it goes lower. Merck breaking out to new highs, relative strength picking up. I think you got a nice leader here. I think Merck's a buy. Microsoft to the downside. You've got relative strength. It's a leader in software, and you saw what happened after it reported earnings. It was horrible. So if that's what the leaders are doing in software, imagine what the laggards are going to do. Stay away from software right now. I love the area longer term. We need to see definitive signs that the Fed's done, that the rates are rolling over. I think when that happens, this group takes a big move to the upside. Until then, I'm watching from the sidelines. Nike trending down on an absolute basis, trending down on a relative basis. It's a sell. Procter & Gamble starting to roll over a little bit, but the relative strength looks pretty good. Watch the 20-week. It's got to get back through the 20-week for me. Travelers, I think starting to show some really nice strength, and it's in the insurance area, which has been strong. Financials, especially insurance, really good. And look at Travelers moving up to about a 3-year relative high. So I think if we get this price breakout, Travelers becomes an excellent buy. UNH, I think, remains one of the best stocks in the Dow. Huge straight move up in relative strength. Absolute move to the upside, right near its all-time high at $543. What's not to like? It's been a great performer. Visa, with its earnings, may be starting to turn the corner. We went back through the 20. We've seen it before, and then failure. So we got to take out this channel and trend line. I think it's improving. Hasn't quite turned bullish yet for me. Verizon, straight down, relative strength, stay away. Walgreens Boots Alliance went back down, put in a slightly lower low than what we saw a couple years ago. Relative strength is weak. Probably another failure at the 20-week. I would stay away from that. Then you've got Walmart. Walmart going sideways, mostly sideways for the past 2 years. Relative strength, though, versus the personal products area has been strong, and it did close, or it potentially is closing on a weekly basis above 140 for the first time. So Walmart showing improvement. I would maybe at this point put it in the neutral category, but I wouldn't be surprised with that relative strength if the market cooperates. I think it's got a chance for 155 to go back up and challenge those recent highs. And that's it. That's the Dow 30 very quickly. I think I did it in about 4 or 5 minutes, but that's a quick update. I wanted to do that because we are heading into a more bullish period of the year. I can tell you that financials love the fourth quarter, as do industrials. So any of those stocks I just talked about that are in those spaces, they could see some historical tailwinds. We've seen the financials acting much better of late. Same goes for healthcare, industrials. So, and energy, of course, has been performing well. Those are some of the areas that I think are probably the safest to stick with right now. Although I think long-term, there are some great opportunities in technology. The question for me is just short-term, are they ready to bottom? And I'm not seeing those signs just yet. All right, let's move on and talk a little bit about earnings. Last night after the bell, we had our earnings event last week, and I don't think I could have been much clearer about how much I disliked Meta Platforms heading into its earnings report. The AD line had set a new low. Its price action continued to move lower. Internet was moving lower. Meta relative to the internet was lower. Internet setting new lows versus the S&P 500. I mean, we have the worst industry group, or certainly one of the worst industry groups with internet right now, and arguably one of the worst stocks in the space, and a stock that is showing a lot of distribution still. This stock looked horrible going into earnings. And they reported last night, and guess what? The report was horrible. It's down 23% this morning, down $30 to $99. That's what relative strength can do for you. heading into an earnings. Is it going to be right every time? No, it is not. There are plenty of stocks that look good heading into earnings and they pull back. And a lot of times that's great opportunity, especially if they've beaten on their earnings. It's buy on rumor, sell on news. Take advantage of it. But you've got to be careful with these companies that are trending down relative to their peers, which are trending down relative to the S&P 500. Wall Street is shunning these companies for a reason. Here's one of your reasons right here. So just be careful heading into earnings. I'm going to go through a couple of others real quick. ServiceNow, I did not like this one going into earnings, and it's up $50. Like I said, they are going to do what they're going to do. 50-day moving average on now is right about where it's going to open potentially. You may see a big black candle today, gap up and failure. I haven't looked at the report on now, but I can tell you it was a laggard. Wall Street wanted nothing to do with it. I would be, if I was in this stock and I was fortunate enough to be in for this $50 pop, personally, for me, I'd sell it at the open. Would take note. I'd probably sell it in pre-market. I wouldn't even wait for the open. I'd be ecstatic to take that kind of a move back to the upside. Look where all these prior lows were on the chart. 430, 420, 410, right in this area. I think it's pretty clear that the support zone then was at from 410 to 430. We broke down, went down to 370. Where'd we fail? 430. Where's the 50-day? 413 or something like that. Now we're moving back on a gap right back into that range. We can't assume it's going to go through 430. Maybe it will. I think the odds are it doesn't. We'll see. All right, I'm running out of time. And why don't we look at three more, and these will be the three you must see. Canadian Pacific Railway reported last night. So looking at the railroads, not showing, we're going to pass on this one. Let's do Ford. Ford reported. So Ford's down 2%. I think we've established a recent high just around 13. Look at the 50-day, or excuse me, the 20-day moving average, which looks like it's probably around the 1240 area. I'd like to see that hold. So that is where I would be looking there. O'Reilly also reported yesterday after the bell. This is one of the best looking stocks out there right now. And it's in the consumer discretionary space, specialty retailer, up 20 with its earnings. So O'Reilly Automotive continues to be very strong. And let's see, I've got one more here. Oh, KLA. Now, this one's significant because it's actually been one of the better semi-equipment manufacturers. I would say it's been the best one on a relative basis. So what is this leader doing after they reported earnings yesterday? They're up $3. That's better than being down 3 or down 30. So good news is it's continuing to show a little bit of strength in a market and in the NASDAQ, which obviously has been weak on a relative basis. So I like the reaction here. I didn't look at the earnings report specifically, but I think the reaction looks pretty good. All right, that's it for me again. November 5th, go over to earningsbeats.com. We've got a big event coming up November 5th. It is free. Sign up, register with simply your name and email address. No credit card, not getting anything like that. It's completely free. Love to have you. Listen, everybody have a great day. Enjoy the rest of the week. Hopefully things will turn more positive from a historical perspective. They tend to be anyway. Let's see what happens from this point forward, end of the year. We turn bullish at the close today. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.